The story you're being told about the German economy is, well, not the whole story. While official numbers and reassuring headlines suggest a country with inflation under control, they're masking a dangerous secret. Europe's industrial powerhouse, the supposed anchor of the Eurozone, is quietly developing a fever. And almost no one is looking at the right thermometer. Everyone is looking at the wrong numbers. While politicians in Berlin and bankers in Frankfurt point to headline inflation figures that seem stable, a silent economic crisis is building. This isn't about the numbers you see on the evening news. This is about the data buried in the footnotes of economic reports, figures that reveal a sickness hiding in plain sight in Europe's most powerful nation. Today, we're going to expose how Germany's secret inflation could be the shock that finally breaks the Eurozone. On the surface, things in Germany don't look half bad. After the chaos of the last few years with energy shocks and supply chain nightmares, the official inflation rate has come down significantly. As of late 2025, it's hovering around a much more respectable 2.4%. That's not perfect, but it's close to the European Central Bank's 2% target, and it's a world away from the panic-inducing levels we saw just a short while ago. Headlines talk about stabilization. Forecasts, while not exactly thrilling, predict a return to modest growth of around 1.1% to 1.4% in 2026. The government is quick to point to falling energy prices, which have definitely helped bring down that overall inflation number. If you only looked at these top-line figures, you'd be forgiven for thinking that Germany, after a rough patch, is slowly getting back on its feet. It's the classic story of the resilient German economy, the sick man of Europe who always finds a way to recover. But this story, the one repeated by markets and the media, is dangerously incomplete. It's a comfortable illusion, and it's distracting us from the real problem festering underneath. The real story begins when you tear that headline number apart. The official inflation rate is just an average, a big mix of all kinds of goods and services. The secret to Germany's economic illness is the massive and growing split between the price of goods and the price of services. While the cost of industrial goods is barely rising at a rate of just 1.4%, the cost of services has been relentlessly accelerating. Recent data from Germany's own statistical office, Des Statis, shows services inflation running at a stubborn 3.4%. More than double the rate for goods. This isn't a blip, it's a trend that's been building for months. Think about what that means. The price of your new TV or washing machine might be stable, but the cost of getting a haircut, eating out, hiring a mechanic, or paying for insurance is climbing and climbing. These are the sticky parts of the economy, the costs driven by wages and what people are spending at home. Not by global energy markets or shipping containers. This is the hidden inflation. It's masked by those falling energy prices and stagnant goods prices, but it's very real for German citizens and businesses. More importantly, economists look at a number called core inflation, which strips out volatile food and energy to get a clearer picture. In Germany, core inflation is stuck at an elevated 2.8%. This number tells you that even without the wild swings in energy, the domestic economy is still running hot. This is the fever the headline number conceals. The president of Germany's Federal Statistical Office even noted that the prices of services kept rising at an above-average rate. This split is the critical symptom everyone seems to be ignoring. So what's feeding this hidden inflation? It's a perfect storm of three things: runaway wage growth, a complete U-turn in government policy, and a dangerous shift in public psychology. First, let's talk wages. For years, German wage growth was pretty moderate. But now the labor market is tight, and companies are reporting widespread labor shortages. In response, nominal wages are climbing and real wages, what's left after inflation, are finally making up for recent losses. On top of that, the minimum wage is on a sharp upward path, with the government commission recommending a two-step increase that could bring it close to 15 euros per hour by 2027. Now, this is great for workers in the short term, but it pours fuel on the fire of services inflation, since labor is the biggest cost for those businesses. As wages go up, so do the prices for haircuts, restaurant meals, and everything else. Second, and this is a huge shift, Germany has abandoned its decades-long identity as a fiscal hawk. For generations, Germany was famous for its debt brake and its obsession with balanced budgets. That era is over. Spurred by geopolitical pressure and years of economic stagnation, the government has unleashed massive spending plans. We're talking about a 500 billion euro fund to overhaul the nation's infrastructure and a huge increase in defense spending. All told, this could add up to €1 trillion over the next decade. While modernizing the country might be necessary, flooding the economy with government money when underlying inflation is already high is a textbook recipe for more inflation. Finally, there's what's happening inside people's heads. There is a shocking gap between official statistics and what Germans feel in their wallets. While the official inflation rate is around 2.4%, some studies have shown perceived inflation among consumers to be as high as a staggering 18%. This is a massive crisis of confidence. When people believe prices are soaring, they change their behavior. They demand higher wages, and businesses raise prices because they expect costs to go up. This creates a self-fulfilling prophecy, where inflation expectations become de-anchored from the central bank's target. That's the point where a central bank starts to lose control. Here's where Germany's problem becomes everyone's problem. Germany's hidden inflation is a ticking time bomb under the entire Eurozone. Why? Because the European Central Bank, ECB, sets one monetary policy, one interest rate for 20 different countries. It has a single tool to manage the economies of fast-growing Spain, debt-laden Italy, and now an inflation-prone Germany. This has always been the Eurozone's Achilles heel, but Germany's new condition makes it infinitely more dangerous. Here is the nightmare scenario for the ECB. To fight Germany's stubborn services inflation, which is being supercharged by huge government spending, the ECB would need to keep interest rates high, or maybe even raise them. But high rates would crush the more fragile economies of Southern Europe, potentially triggering recessions and another debt crisis. On the other hand, if the ECB keeps rates low to help out countries like Italy or France, it would be letting inflation in Germany, the bloc's largest economy, run wild. This divergence creates an impossible choice and strains the very fabric of the monetary union. An ECB policymaker recently said it's important that inflation rates in Europe don't diverge in the longer term, but that is exactly what's happening. Germany is slowly morphing from the Eurozone's anchor of stability into its main source of instability. While other European economies see inflation cooling, Germany is developing a unique, homegrown inflation problem that the ECB's one-size-fits-all policy can't fix. This isn't just an economic debate, it's a political one. How long will the German public put up with an ECB policy they see as too weak for their own country? How long will other countries tolerate a policy that's too tight for theirs? This is how the Eurozone could break. Not with a bang, but with the slow, grinding pressure of economic divergence, led by a sick German economy that infects everything around it. The story of the German economy has changed. The old narratives of fiscal discipline and export might are being replaced by a new reality of massive government spending and stubborn domestic inflation. The official numbers are telling you one thing, but the data just beneath the surface reveals a much more alarming truth. Germany, the bedrock of Europe, is now generating the very instability the euro was designed to prevent. The question is no longer if this will become a crisis for Europe, but when. And as Germany's hidden inflation continues to build, the rest of Europe may soon discover that its anchor has become a milestone. If you want to understand more about the structural problems facing the European economy, be sure to watch our next video. And as always, if you found this analysis valuable, hit that like button and subscribe for more content that goes beyond the headlines. What do you think? Is Germany's new path a necessary investment or a reckless gamble? Let us know in the comments below. Subscribe for data-driven breakdowns of trade, tech, and money. Signals, not slogans. History rhymes. Power rebrands. Stay inquisitive.